And we're back with more questions about the Greeks. So welcome options traders, and today I wanted to talk about how does gamma change? And in order to make better decisions for your strategies, it's not just enough to understand the definition of gamma, but you need to be able to anticipate it and to understand how it's going to change. Now, I probably should have entitled this video as How, When, Where, and Why Does Gamma Change? Because that's really what we're going to look at. But it's super important that you not only understand the definition of gamma, but how to answer these questions. So let's go find out how. Now, I just talked about this recently, but let's do a quick review of gamma just for the basic definition. And once again, this is what most traders start with. They understand the definition and they think that's everything they need to know. And it's just simply not true, but this is definitely a starting point. So gamma is one of our Greeks. It's a mathematical output from a pricing model, and it simply shows the acceleration of your deltas. Now your deltas, remember, show you the option sensitivity to its price relative to the stock's price. So let's say that the stock is trading for 100 and the broker's platform says that the $100 call is trading for $5. So it's an at the money option. And our broker's platform also says that it has a delta of a half. And that's generally going to be true for the at the money option, regardless of the time to expiration. Now we also look on our platform and we find out that gamma is 0.03. So what this means is that if the stock makes a $1 move right now to 101, your option's price is going to increase by delta. Now to understand what that means, remember that delta, at least one interpretation, is the percentage change that it's picking up or losing from a change in the stock's price. So since we have a call option, the call option's price will rise as the stock price rises, and it's going to fall if the stock price falls. So if the stock rises $1 right now, delta says we're going to pick up 50% of that move, or 50 cents. So we would expect that this option's price will move from 5 to 5.50. See, notice it didn't move from 5 to 6, which is what a lot of traders think. They'll say, well, the stock rose $1, so my option's price should move $1 as well. And that's not true. Delta simply shows you that connection. But also recall that your Greeks change all of the time. Unless you're super deep in the money or super deep out of the money, they're pretty much going to be changing all of the time. So as the stock made this $1 increase, your delta is going to change. By how much? That's where gamma comes in. Gamma shows that our delta is going to increase by 3 ticks. So it's going to go from 50 to 53. We're just finding that by taking the old delta plus gamma. Now, of course, after the stock makes that $1 move, you're going to get a new options price, a new delta, new gamma, new theta. All of your Greeks change. So delta again shows how sensitive the options price is to changes in the stock's price, while gamma shows you the sensitivity of delta. Okay, so again, that's really the basic definition of gamma. But to understand how, when, why it changes, you have to also understand that gamma represents the curvature. And when I'm talking about curvature, I mean the curvature of your options risk graph, that profit and loss diagram. Now, it turns out that the greater the curvature, the greater the gamma. So if you're at a point on this risk graph where that risk curve is really bent, then that's got a lot of gamma at that point. And you'll see why in a moment. But if it's fairly straight, then there's not a lot of gamma. So if you want to get good insights into how and why and where gamma is going to change, recall that delta shows the approximate probability for the option to expire in the money. That is another mathematical interpretation of delta. So if we had a delta of 50 that we just saw, there's roughly a 50% chance for that option to expire in the money. So the way that you want to understand gamma and to conceptualize when, where, and how these changes are going to take place, understand that if the stock price move, let's say this $1 move up or down, sharply changes the probability for the option to expire in the money, there's a lot of gamma. So that can be a little bit of a confusing definition, but let's look at it graphically. Picture will make it a lot easier. So here's our risk graph. We've got a $100 call option in black is the expiration graph. Remember, that curve only applies at expiration, and the red curve is the current curve. These are the profits and losses that we will see right now, today, at these various stock prices. So the difference between the red and the black curve is simply the time value or the extrinsic value. Now, a little different approach that I've taken here from previous risk graphs is that I've drawn this in what's called a payoff diagram. Notice that the very lowest point is 0, which makes it look like you can't take a loss. That's just saying that the option would be worth 0 right here. We're looking at the payoffs of the options, not the profit and loss. And the reason I did that is we're going to be looking at different expirations, and we would therefore get different values for the options. So to put them all on a level playing field, we're just going to look at a payoff diagram. So right now, take a look at this red line. Do you see how it's curved? We can see that there is therefore some type of gamma. But the curvature is more here in the center. And that will always be true. The at-the-money options have the greatest gamma. They also have a maximum for all of the other Greeks with the exception of delta. But take a look way out here. So remember, we've got the $100 call. Let's say the stock is out here maybe at 75 or so. Do you see how this red line is fairly flat? Almost exactly flat like this black line. The slope of that line is delta. And so it's getting pretty close to 0 out here. In fact, if we went further left with the stock prices, it would eventually hit 0. But what this is telling you is that this option right now is so far out of the money that there's, let's call it roughly a 0% chance for it to go in the money. Now at the other extreme, let's say the stock is up here maybe closer to 130, up in this range. Do you see how this red line is fairly steep? In fact, it almost matches the steepness of this in black, which remember at expiration is delta 1. So right now, we might not be exactly delta 1, but we're going to be pretty close. And when I say delta 1, that's also delta 100 because each contract controls 100 shares. And that's just saying that if the stock price moves $1, your options price is going to pick up roughly 100% of that move, or will also move $1. So why are these risk graphs fairly flat out here? Why is there not a lot of gamma? Well, go back to the definition. Think about it. Let's say if the stock is down here at 75, and maybe there's 30 days to expiration on this red line, and the stock now moves to, let's say, 76. $1 up. Is that really going to change your opinion about the stock's price being able to get above the 100 strike? Probably not. There's not a very big change in that probability. And that's why the red curve is very flat. Stock could go to 77, 78, up here to 80. Not going to make a big difference in your opinion because there's just not a lot of time remaining relative to the stock needing to make that move. Now, on the other hand, if the stock is way up here, again, let's say at 125, and it falls to 124, is that now going to radically alter your decision and your belief that it option has less than a 100% chance of being in the money? Probably not. You're just going to look and say, you know what, it's still really deep in the money. There's not a lot of time to expiration. I'm still highly confident this option will be in the money. And that's why this red curve is fairly flat up into here. It's got a delta close to 1, but it's also very flat. But notice what happens when you get closer to the strike. Notice that if the stock is just a little bit to the left of 100 here, a little bit below 100, do you see the steepness of this line right here, or shallowness, however you want to look at it? That arrow? It's got a little bit of steepness to it, but it's fairly flat. But if we get just above 100, look what happens. Do you see how it's really ramped up here a little bit? Pointing much more to, let's call it the northeast corner. So if we were to extend some imaginary lines from this first arrow and the second arrow, you could see that there's not a huge difference between them. There is a difference, but it's not enormous. And so that tells us that there is a little bit of gamma. We are going to see some changes in that delta. But now let's say there's less time remaining, maybe only 15 days. We move from the red curve to the blue curve. And look what happens now. You see how it's starting to get more compressed here in the center, getting a lot more of a bend? Think of this red line as a piece of wire or a coat hanger that you're bending. And you can see that if you went from the red to the blue, you're putting more stress here. You're starting to bend it more in the center. And we can also see that over here to the left of 100, we can see that it's fairly flat. In fact, it's a little bit flatter than it was up here. And that's because with the stock down here below 100 and only 15 days to expiration, now we've got even less confidence about that option being in the money. But if that stock just happens to cross 100, even by a penny or 5 or 10 cents, then we start to get on this steeper portion. And you can see that that's quite a difference in that steepness. So let's again extend some imaginary lines out from these arrows. And now you can see there's a bigger gap between them. It's another way to understand that the bend in this blue line is harsher, let's call it, or more pronounced than it is for the red. And that's telling you that there is more gamma. You're going to see a bigger acceleration in your deltas on the blue curve than you will on the red. Now also notice that the blue curve is starting to disappear up into here. Stock price of 115, it's already overlapping this black line. Stock price down here at, let's say, 90 or 85, it's also overlapping the black line. That's telling you that because there's even less time till expiration, if the stock is down here, now you're highly confident, or at least relatively speaking, a lot more confident that this option is not going to make it in the money by expiration. Conversely, if the stock is up here, maybe even only at 110, you're almost 100% certain that it will be in the money. We don't need it to be as deep in the money as we did on the red line because there's more time. All right, so that's what's happening. This red line is now starting to collapse towards the black. And that collapsing is causing a bigger bend in the blue line, and that's telling us that we have more gamma here in the center. Now, what would happen if we go very close to expiration, maybe 5 days until expiration? Now our risk graph looks like this in green. In fact, the green line extends way out here to the left and way up here to the right. You just can't see it because it's exactly overlapping that black curve. But notice if the stock is just a little to the left of 100, maybe even 99.90 or less, that green curve is fairly flat. But if the stock happens to round the corner and get up above the strike, even by a little bit, 5 or 10 cents, look at how steep that line becomes now. So if we extend these lines out, look at the difference in those gaps. See, there's a lot more bend here on the green, and that's because we are still at the money, but with almost no time to go. So I've talked about using a sports analogy. Any sport with a time clock, think of it like a football game. If your team is behind by, let's say, 3 points, and there's just seconds on the clock, and they make a score, what happens to your opinion about the probability of that team winning? It rapidly changes from close to 0 to now 100%. That's what's happening. There's not much time on the clock. It wasn't out of the money option. A few pennies later, now it's in the money, and it greatly changes those probabilities, and therefore it's greatly changing your deltas. And if that's true, it can only happen because you have a lot of gamma. And that just means there's a lot of curvature here on the green line. Now, just for comparison, let's go out to maybe 1,000 days to expiration, close to 3 years. Look at this. Look at how straight that is. Why is this risk graph fairly straight? Now, first notice that it sits away from the black line very far because there's a lot of extrinsic value. But it also means that we're not going to have a lot of confidence being in or out of the money. So notice now if the stock is down here at 99, do you think that there's no chance for it to be in the money? Of course not. You've got plenty of time for this option to become in the money. And that's why the deltas don't change that much. The slope of this pink line here is roughly the same almost throughout this entire graph. If the stock happens to go to 101, do you now have a ton of confidence that it will absolutely be in the money at expiration? Not at all. Still plenty of time for it to fall out of the money. See, little changes in the stock's price are just not altering your probabilities or your assessments all that much compared to down here when you have less time. So you can see that if the stock is below 100, right here we've got this kind of an angle. If it's above 100 in the money, it's got this angle. But look at those two. Virtually the same. Not a real big change. And that's telling you there's not a lot of curvature and therefore not a lot of gamma. So I hope this gives you a better visualization of what's happening with your gamma, where it's coming from, and how it's going to change, whether the option happens to go deep in the money, out in this direction, or deep out of the money in this direction, or if it stays close to at the money, but we have different expirations. So you can see that if you're at the money, your highest gamma will be for the shorter dated options, and then it will gradually decrease as you go longer dated. But if you have really good insights into how your Greeks change, and in this case how gamma changes, it will make your decision processes much easier. You can anticipate where your deltas are going to swing, whether they're going to increase, decrease, and by how much. And it all begins by understanding how, when, where, and why your gamma changes. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.